Hi everyone and welcome back to another video. Today, of course, as you can see, we're doing Q&A for the month of April 2019. Thanks to everyone who left a question below last month's video and below the post that I made on the community board. So of course, if you have a question for next month's video and you didn't get one in for this week, or for this month I should say, leave them below this video right here. And I'll also be making a post on the community board about a week before I do that video. That'll be in a month. And you can also leave a comment below that if you have a question. But without further ado, let's just jump into this month's questions and let's get started. So the first one here was from Sensory Overload, and they are asking, what are your long-term strategies on compounding inflation? Sometimes it feels like a losing battle. Yeah, so inflation is something that we all have to live with. We all have to accept that the purchasing power of our money is going to go down over time at somewhere roughly between 1 and 3%, depending on which time in history you look at. More recently, inflation has been very slow in the US and Australia. I'm talking about usually somewhere between 1 and 2% it's been recently. So in order to protect yourself against inflation, it hasn't been that difficult in recent times. If you go and put any excess cash that you have in a high interest savings account, most of the time you can get 1.5 or 2%. If you go for a term deposit where your money is actually locked away, where you can't access it for 12 months, maybe 3 years, maybe even longer, or a 5-year term deposit, or if you're buying a bond where, again, your money is likely going to be locked away for a certain amount of time, then you can even get a higher percentage, somewhere between 2.5 and maybe 3% at the current time. So that is how I would protect my cash against inflation. I would just put it in a high interest savings account. That's where all of my cash is. It's split between a high interest savings account and my business transaction account, which also earns interest on itself. So just high interest savings accounts. I don't go to bonds just because I don't find it that necessary to go to bonds to get an extra 0.5%. I can already get about 2% on my high interest savings accounts, so that's enough for me. And of course, by owning businesses, you're protecting yourself against inflation. Because let's say you own pretty much any business, but let's say you own a beverage company. As inflation increases the price of goods, those businesses are going to increase the prices of their beverages, which means they bring in more revenue and produce more profit. So by being an owner in a business that can increase their prices with inflation, you're going to be protected against inflation. And of course, it's very likely that if you're following a strategy like the one that I follow, you're going to be investing in businesses that are going to grow at a much higher rate than inflation. They're more likely going to grow at somewhere between 10 to 20% per year over the very long term. The next question we've got here is from Anthony, and he asks, would you buy over-the-counter OTC stocks? Buffett says that he could do 50% a year if he started again with a small capital base. That's how he did it the first time. Why don't you take advantage of your smaller capital base by going into illiquid microcap special situations and finding mispricings? So yes, Buffett has said that the reason why he can't get a massive return anymore is because he has too much money. And that is just a reality of, as you compound your wealth over time, you have to put that money, you have more money to put into a business. And especially when you're at Buffett's size, where you have over $100 billion in cash, if you buy any company that, well, for starters, he can't really buy a company that's smaller than $1 billion, because if he starts making an investment, if he's going to buy the whole company, he's going to shoot the stock price up massively, and his volume of buying shares is going to be way too large for that business. So he can only really look to businesses that have market caps above, say, 20 billion, where if he buys 5% of the company, that's going to be maybe a $1 billion investment in that company or something like that. But essentially, the reason why I don't do what he did at the very start is that I don't think that that's a particularly necessary strategy. It's a completely different strategy to something that I do. Maybe it's a good strategy. I don't know. I haven't looked into it. But the strategy that's worked for me is just finding really successful businesses that we know are going to be great over the long term. And these really successful businesses occasionally get mispriced because they have some sort of short-term event, which means that Wall Street and the big funds hate the stock and it sends it down massively. And those stocks offer opportunities to make 15%, 20%, or even more in those businesses over the very long term. And if you can exploit those situations, then that is very much the same as trying to exploit small cap special situations. It's just a different area of investing. If you want to look in that area, then I would say spend all of your time learning exactly how to do it, which is what I do with the strategy that I use with mid to large cap stocks. So there's no real reason I don't look at it. It's just that the strategy that I use, looking at mid to large cap to mega cap stocks, I guess you would call them, and looking at really great businesses that have 1 or 2 years of poor profitability because they have a problem. That's my area of expertise, and it's what's worked for me. So I continue to learn everything about that strategy, and I continue to apply it. I don't need to look elsewhere because the strategy that I'm using is working so effectively. The next question we've got here is from Kevin, and he asks, if you are a value investor, why do you keep 20% of your investments in index funds? Isn't this diversifying to the opposite effect of stockpiling as a value investor? And yeah, sure, you are correct. Part of my value investing philosophy is that you don't want to over diversify. You want to invest in a few specific businesses that you thoroughly understand. Maybe that's 5 to 8 businesses that you thoroughly understand, and you want to continuously invest in those businesses over your lifetime, because if you focus on one business, let's say, and you learn everything about it over 20 or 30 years, then you are going to know exactly when is the best time to buy it, depending on the problems that arise in that company. And you're going to know what problems are short-term problems and what ones are long-term problems where you would want to actually get out of the stock. Now, as for the index funds proportion of my portfolio, it's simply a foundation. It's something that I've built from the very beginning of my investment journey as sort of a protective layer against those individual picks. So diversifying completely in the entire market is something that Warren Buffett advocates most people do if they don't want to actively pick stocks, because of course picking stocks is very difficult and you need to have the discipline to look into every single little crevice about that particular business. So for me, it's just a foundation. It's just a part of my portfolio which will likely get smaller over time. I will likely dedicate less money to that proportion over time as I get more confident in my individual picks. But for now, it's just a nice foundation that is going to go up with the Australian economy, because it's an index fund that tracks the top 300 companies in Australia. So that's going to go up over the long term. It's somewhere between maybe 6 and 10%, depending on how the economy goes over the very long term. And I'm happy to have that part as a passive part of my portfolio, and then focus the other 80% of my money on picking individual value style investing businesses. The next question we've got here is, in a previous video, you said that the S&P 500 and the All Ordinaries, so that's the US market and then the top 500 in Australia, have about the same return to 9 to 10%. But when I Googled their indices and compared them, there was a massive discrepancy, and I feel like the US indices outperform Australia. So why do you bother tracking the Australian indices? So I presume that you've looked at the US and the All Ordinaries within the past, say, 10 or 20 years, because in the past 10 or 20 years, the US market has massively outperformed the Australian market. And the reason why, well, partly it's both of them have dropped their interest rates very low, but part of the reason why the US market has so much more outperformed the Australian market in the past 10 years is the different approaches that their central banks took to coming out of the global financial crisis. So the US was in a very unstable position in terms of their financial institutions during the global financial crisis, whereas Australia, really, we didn't even go into a recession during the GFC. And that resulted in two very different sort of policy-making decisions by the central banks of those two countries. And the result is that the US economy, the US stock market at least, has performed a lot better over the past 10 years. But that's just one 10-year period. And if you look over 100 years of data, which is basically the best data we have on the US and Australian markets, they're both very similar. And in fact, the Australian economy has outperformed the US economy over 100 years. So you could pick a 10-year period, and yes, you could say that the US market has outperformed the Australian, and maybe that will continue. Maybe it's true. But if we look at all of the data we have, they're very, very similar. This person had another question, and they asked, imagine if you had two stocks, one that had no dividend but an annual growth of 10%, and a second stock which had a dividend of 4% and annual growth of 6%, assuming that you reinvested the dividend. Which stock would be better? So they would be very similar, I would say. That's the first thing. Both of them are compounding their cash flows at 10%, because the first one is growing by 10%, reinvesting their cash flows, growing by another 10%. Whereas this other company is investing 6% and growing it into 10%, but paying out 4%. So they're paying out some of their earnings and keeping some to reinvest, and the other one is reinvesting the entire amount, and then you're going to be reinvesting that dividend. So personally, I prefer companies that don't pay a dividend if they are getting a high return on their investments. And the reason for that is because if they pay out me cash and I'm going to reinvest it, then I have to pay brokerage fees to reinvest that money. Whereas if the company just keeps it internally and reinvests it themselves, then it's essentially the same thing, and except that there's no brokerage fees associated with that. So I would much rather invest in a company that can just keep the money and reinvest it for me and compound it for me, rather than kicking me out the profits where I've got to go and find another investment for myself. And the other thing to mention is that if you're reinvesting a dividend automatically, or even if you're just doing it yourself, you're pretty much at the mercy of the current stock price. Whereas if you just invest in a company that is reinvesting its dividends, then you're not at the mercy of the current stock price. You invest in that stock when it is cheap, and then you can just hold on to that, and the company is going to be reinvesting their cash flows for you. Whereas if you get that 4% reinvested, it's going to be reinvested at the current stock price, regardless of whether or not it's undervalued or overvalued. The next question we've got here is, hi Hamish, I would like to hear your thoughts on paying down student loans, such as HECS, which is our Australian student loans, first, or investing first, or do you do both? Or delay paying the HECS and focus on potentially better returns from the ASX. All right, so in terms of debt, the way you look at it is what interest payment are you paying on that debt? So if you've got high interest debt, such as a credit card, that's 20% debt, then if you just pay that down, you're essentially getting a 20% return on your money. Because when you pay down that 20% interest debt, you no longer have to pay 20% out. So you save yourself 20%, which is the same thing as making 20%, basically. So if you have high interest debt, then you definitely want to pay that down first before you invest, because the only reason you would invest while you had 20% credit card debt would be if you could guarantee yourself that you're going to make more than 20% in the market. So that would be like you investing in the market, making 30%, and then using 20% of that profit to pay down the debt. You'd still be up 10%. But in most circumstances, that is a terrible idea, because you're not going to be able to guarantee that you can make 20% in the markets. So the only reason you would hold on to debt would be if it was low interest debt. And HECS, for example, student loans in Australia, they don't really have an interest rate. They go up their interest rate is essentially just the rate of inflation. So it's somewhere between 1% and 2%, which means that if you can make more than 1 or 2% in the market, it is better to invest rather than pay down your HECS. So for me personally, I have a HECS, and I'll be paying it down as slowly as possible, because it's only 1 or 2%, and my capital can be better invested in the markets, where I can get somewhere between 10, 15, 20% or something in that range. The next question here from James is, what is Warren Buffett's or Berkshire Hathaway's percentage cash right now? So I don't know off the top of my head, but their cash at the moment is about 100 billion. And if you look at his stock portfolio, so just the stocks that he owns, not the whole businesses. So just looking at the stocks, I think he has about 77 billion in stock. So that would mean that he has more than 50% cash compared to his stock. However, that's not a fair comparison because Berkshire Hathaway owns a lot of whole businesses. It's not just stock. So if you look at it in comparison to their assets versus their cash, then their cash is, I think, somewhere between 20 or 30% of their assets. It's something like that, just off the top of my head. But he's certainly holding on to a lot of cash. And while he's continuously investing, of course, because he needs to deploy, you always want to have a significant amount of money in the market because the market is always more likely to go up than down most of the time. But then there's times like right now where stocks are very, very high and the returns that we can get on those stocks are low as a result. And that means that you want to hold at least a substantial amount of cash because if those prices come down, the return you can get on those stocks will go up. And it means that you can then shovel all of that money into the market. The next question we've got here is, hi Hamish, what are the usual technical signs of a stock that a stock of a great company has hit the bottom and is about to revert upward movement? I don't use technical analysis at all. So I don't use any signs. I don't try to pick the bottom. I don't try to pick the top. What I do is I look at the actual business behind the stock. I don't look at the price movement in the past, and I don't try and predict where it's going to move in the short term in the future, or even in the long term in the future based on price movement. I just look at what I'm buying, which is an underlying business that generates profit. And that's what I'm looking for. And if I can calculate that I'm going to get back a lot more than what I'm putting out when I make that investment over the long term, then I buy it. That doesn't mean I'm going to hit the bottom. A lot of the time, stocks may continue to fall after I've bought them, or they might bounce straight back up. But I think that's more luck. I don't think it's really possible to pick the bottom of a stock, but it is possible to pick when it's a good time to buy and when it's not. And the last question we've got here is, could you analyze Chipotle Mexican Grill? And I've had this question so many times and I apologize for not getting around to it, but it is coming. I am analyzing Chipotle. It's a company that Phil Town advocates for a lot, or at least he's had success at investing in Chipotle in the past. So yes, I will be doing an analysis on this company. I've looked at it many times over the past couple months. I just haven't put together a video yet, but I will be doing that. But thanks for everyone who left a question below last month's video and below the post. So of course, again, if you have a question, leave it below this video or leave it on the post that I'm going to make in about a month's time. But thanks for watching, guys. Leave a like if you enjoyed, and of course, hit subscribe if you want to see more. But for now, guys, I'll see you in the next one.